Good afternoon and welcome to a new arrow for the Pension Practitioners Quiver, Pension Risk Transfer, the first of a series of 2012 webinars hosted by the team at Dietrich Associates. On behalf of Jay, myself, and our team, we would like to welcome you and thank you for taking your time out of your busy schedules to tune in to what we know will be a very valuable and informative session. I will be your webinar organizer today, and I'm the Vice President of Marketing and Sales at Dietrich Associates. Jay D'Annunzio will be our session's presenter today. Jay is a senior consultant at Dietrich Associates. Jay's responsibilities include business development in addition to client consulting, and he works closely with pension sponsors and consultants, helping them evaluate, monitor, and execute strategies that reduce or eliminate pension risk. A pension risk transfer thought leader, Jay's recent works include developing the first pension risk transfer index in the U.S. to help pension plan sponsors evaluate monthly changes in the attractiveness of annuitizing pension liabilities. Additionally, he has authored the recent white paper, Pension Risk Transfer Solutions, Adding Guarantees to the Defined Benefit Fixed Income Conversation. Prior to joining Dietrich Associates, Jay spent over 10 years working inside the institutional annuity business units of two large life insurers, where he supported more than $1.5 billion in sold annuity contracts to pension plan sponsors. Before I hand it over to Jay, there are a few housekeeping items to take care of today. First, you'll notice the GoToWebinar dash on the right-hand side of your screen. Feel free to move this around if it is obstructing your view of the presentation. Second is that on the same dash, you'll notice a tab where you're able to submit any questions you may have during the presentation, although we encourage you to save your questions until the end of the presentation for our Q&A session. Any questions that we do not get to will be answered individually after the webinar. And with that, I'd like to hand the presentation over to Jay.
Thank you, Krista, and thanks everyone for taking some time out of their busy Thursday afternoon or morning, depending on where you're joining us from. Before we delve into the abyss of insured pension investing, I wanted to just kind of warm up the group and talk about what I see as a pretty clear 800-pound gorilla that is in the room. It's in my room. It's in everyone's room that's on this call here today. And what better way than with a quick survey? So Krista, if you wouldn't mind putting that survey question up to get everyone kind of dialed in here this morning.
Absolutely. For about 70% 8 voted.
All right. So the Super Bowl. The Super Bowl is the 800-pound gorilla. So trying to get a sense here for where the allegiances of the people on the phone lie. What are we showing for results, Krista?
We're at 57% to 43 for the Giants, and we're 87% voted. We're almost there.
All right.
So it's looking like the Giants right now.
For those of you that are still considering a friendly wager, the Pats are going out at -3, and the over/under's at 54.5.
All right, I'm going to go ahead and publish this poll. All right. There we go. 56% New York Giants, 44% New England Patriots.
All right, so I guess it's go G-Men. Very good. Without any further ado, let's delve in here. We thought we would kick off today's discussion with really just sort of a slide that talks about illustratively the state of the pension market. And these are a bunch of themes that come up in most of the interactions that we have with pension plan sponsors. There's probably one thing that's noticeably missing that has been on every pension presentation that's been done in the last 6 years, and that's the Pension Protection Act. You know, we thought it didn't need to be, that drum has been beat to death, so it's sort of the cost of doing business in this day and age. But interestingly enough, the Pension Protection Act, as many of you probably know, reduced the incentive to taking investment risk in a pension plan. And now, in 2012, plan sponsors are finally feeling the full brunt of what what PPA was originally intended to do, now that sort of some interim stopgap measures of relief, funding relief, have sort of gone away. But low rates and underperforming equity markets have really challenged, I think, many pension plan sponsors from being able to de-risk their pension plans. So again, starting off here at kind of a macro level discussion, we see four camps of pension plan sponsors. The first is what I would call the largest group, but a slowly declining group. And this would be the guys that I'd call the roll the dice group. And these are plan sponsors that are either comfortable with their equity exposure or they're uncomfortable with moving into LDI at the current in the current market conditions. The second group is plan sponsors that are looking to de-risk gradually, and this is the group that are looking at glide path, kind of dynamic asset allocation strategies to kind of slowly phase their way into some sort of an LDI strategy. The third group is what I would call the immunize and predictably fund over a period of years, really investing heavily in fixed income and trying to lock down a contribution strategy to try to predictably buy their way out of their funding issues over time. Sort of, for the group of clients that are really focused on strategic planning, I think there's a growing group of pension clients that are falling into that third bucket. And then the fourth bucket is what we would call the bite the bullet group. And this is the group that's potentially ready, willing, and able to write a check to fully fund and terminate. So this, as you can imagine, is probably the smallest group. But when we look at the conversations that we're having and the economic outlook, the interest rate forecast, the fact that a lot of these businesses do have cash or access to low-cost borrowing, we think there's more sponsors than ever before that are seriously considering if and when to bite the bullet. So in wrapping up this slide, if I were to look into my crystal ball and offer one prognostication for folks on the phone here today, I think the one thing that I'm fairly comfortable we will see in the years ahead is increasing allocations to fixed income type vehicles in most pension plans in the years ahead. And the timing of how and when it's going to happen is up for debate, and will be client specific. But I think companies are going to want to protect their contributions. They're not playing with just house money anymore, and they're going to really want to try to stabilize funding. So fixed income is quite clearly the way that's going to happen for most pension plan sponsors. I'm seeing here, Krista, it looks like we have a question coming through for this slide.
We do. The question would be, are any of the items on this slide more concerning to pension sponsors than others?
Yeah, I would say the two that jump out are contributions is a big one. Most pension plan sponsors are looking at some pretty significant contributions for this year and the years ahead as well. So contributions is probably the biggest one. Correlated with that is probably funded status volatility. Again, it's always going to be facts and circumstances that drive sponsor behavior. The only other thing worth noting, I would say, is the size of the plan relative to the size of the sponsor's business tends to be a big driver of decision making in how a company may view its overall pension risk.
Right.
All right. So talked a little bit about fixed income, and I guess I've sort of hypothesized that fixed income is positioned to be the white knight of the pension market. And when we think about insured pension risk transfer solutions, we're increasingly trying to frame them in the marketplace as attractive fixed income alternatives. These products, and to the extent that they're issued by some of the world's largest fixed income investment managers, i.e. insurance companies, we think they can do a lot of things for pension plan sponsors. We've tried to summarize them here on the slide. Reduce plan size and complexity, so buying out or buying in a tranche of liabilities, immunizing plan liabilities, and then, of course, plan termination, sort of the old stalwart or terminal funding that most people on this phone are at least probably familiar with and some way, shape, or form. But just to give a little more color to the prevalence of institutional group annuity products in the retirement marketplace, I pulled some data from an ACLI fact book that I thought might lend some support to the utilization of these products in the market. And the first data point is that $100 billion of group annuity premiums were deposited in 2009. That's the most recent year where we could get the data. And there's about $800 billion of total group annuity reserves on the books of life insurance carriers in the U.S. Of that $800 billion, I would estimate that minimally $100 billion would be associated with defined benefit plan liabilities. So not an insignificant amount of pension liabilities already sitting on the balance sheets of large life insurers. And we think when we look at the trends in the pension market and how LDI is set to really be more attractive in the years ahead, we think insurance products can play a big role in those discussions. That said, I think the marketplace does tend to be somewhat myopic in viewing guarantees only through the lens of a pension plan termination. So I would challenge folks on this call to think about the things that are going to follow on the next couple of slides as pension risk management tools. So these products can add tremendous value today to help pension plan sponsors figure out how to invest their assets in ways that are going to help them achieve their funding objectives. And if I were to just sort of try to summarize the value of these products, I think it would be very simply they're custom, cash flow matched, fully guaranteed investment vehicles that allow pension sponsors to precisely match assets and liabilities. So when you look at, and I think these products are going to be attractive kind of in the small and middle market, so probably plans smaller than $250 million in total assets, where they're primarily using pooled either mutual funds or collective trust products today. We think that the customization available through the insurance market is going to be a huge benefit to plan sponsors when they get to the point of really having more tactical and engaged conversations around LDI. And I'm getting a little note from Krista that there's yet another question on this slide.
Yes. The question is, what risks are sponsors exposed to by investing in an insurance contract which represents an undiversified single issuer credit risk?
Yeah, this comes up, especially as soon as you start talking about using insurance products outside of a plan termination. So if a plan were going to invest in an insurance contract as part of its ongoing investment portfolio, this becomes an issue. And I think the first point is that due diligence is very important. Getting an understanding of the underlying diversity and quality of the investment portfolio, the capital and surplus position of the insurer. We've got DOL 95 up on the slide, so looking at the things that are considered as part of the safest available annuity provider standard are certainly things that folks are going to want to do that are evaluating these solutions. Other things that come to mind, we're seeing new separate account structures come into the market, so there's new forms of credit protection other than just general account. Liquidation provisions, some of the contracts that are in the market today are not complete lockups, and they do have liquidity provisions, so evaluating and understanding those provisions is also very important. Thinking about the insurer's credit profile, and then how does that compare to the sponsors, the plan sponsor's credit profile. I mean, ultimately, we think that the risk of insolvency on most of these carriers is fairly remote, and that the thing that plan sponsors should think about first and foremost is the fact that they're actually, in most instances, going to get a material upgrade in credit quality behind the guarantee relative to their own balance sheet. So definitely some things that sponsors need to think about, but we think when you put all that into your pipe and smoke it, guarantees are still going to be a very powerful option for pension plan sponsors from a risk management perspective. So we wanted to illustrate the spectrum of different solutions that are out there. And we sort of see there being sort of 4 core contract structures that are available in the marketplace today. And before we drill in here, and we have some other slides behind these that we'll drill in a little deeper, we want to just quickly remind folks that, again, as we're talking about these, we're thinking about potentially redistributing the plan's existing fixed income. So we're talking about these, again, from the perspective of the embedded fixed income investment that you're getting within the insurance contract. So with that said, I would ask people to think about 2 questions before we start to talk about this slide. Why are we, and we would be you on this call, why are you using the fixed income funds that you are today? And then what are the pros and cons of cash flow matching some portion of the pension portfolio? We ask that question because that is one of the inherent benefits of insurance products, is they do provide a nice cash flow match solution that can help manage risk. But we can drill into the slide here now a little bit. In the upper right, we have the buyout annuity. This is the product that everyone wants, but few feel like they can afford. It's pretty much the complete risk removal and legal transfer of plan liabilities. So with complete certainty, that certainty usually comes at the highest cost. And when you look at the environment that we're in today, with many plans underfunded and interest rates low, the perception around cost is that these are very high cost solutions because of the added impact of buying out the liability on adding additional funding to the plan. If we move down a little bit into the left, we have the buy-in annuity, a relatively new structure. I believe it saw its first buyer around middle of last year in the U.S. And this is a structure where it's largely similar to a buyout annuity, but a key difference is that the plan owns the annuity contract as an asset. So it in essence, reinsures the retiree liabilities. Again, very high certainty from a guarantee or risk transfer perspective, and also high cost. Not as high as a buyout, because one of the key benefits of a buy-in is that there's no impact to accounting or funding. So from that perspective, the feasibility in current environment for a buy-in transaction for many plan sponsors may be more feasible than a buyout. As we walk down the center axis, we have yet another kind of new innovative structure in the marketplace, and again saw its first buyer at the end of 2011, something called insured or guaranteed LDI. This is where an insurance contract guarantees the pension discount spot rate curve used to define the liability value. They do not guarantee 24-month PPA segment rates for reasons that you can probably imagine, but it offers a precise liability hedge across the yield curve, and we think for many plans could be a very compelling alternative to a traditional long bond fund. So certainly a new exciting option that we haven't had before. And then the last solution here in the lower left-hand corner is just traditional kind of fixed crediting rate products. And these are products that insurance carriers have had for a long time. But when you think about them through the lens of kind of pension funding, they're really a short or intermediate bond alternative. They give stable returns. They allow you to protect principal and enhance yield over cash. Where we think it becomes at least relevant for a plan sponsor to think about is that sort of embedded investment strategy does correlate pretty well with PPA segment rate 1, which defines a large percentage of plan liabilities. So there's 4 different solutions on this page. They're all sort of different in terms of their structure and where the investment strategy falls on the yield curve and a bunch of other things that we'll get into, but we think that it allows for a nice conversation with a pension plan sponsor around how they may be able to get kind of a guaranteed, customized fixed income investment strategy. And we have a question coming in here.
The question is, what factors do you think will increase utilization of insured pension risk transfer products?
Yeah, and so I think, what's implied by the question is that, using insurance products outside of pension plan terminations is still, not quite the norm. So what is it going to take for this stuff to really take up in the market? And I think there's really three things. One is increased marketing by service providers. So this webinar is a good example today. I think insurance carriers are beginning to market this stuff in ways that they just haven't in the past. And that's brought about by the opportunities created by PPA. So I think as we move ahead that, just increased marketing of this stuff is going to be huge. We're already starting to see some fundamental changes in how these solutions are discussed in the marketplace. More clearly, I think rising rates and improved funding will be another big catalyst, not just for this, but for LDI and fixed income in general. I think it'll be very interesting to see when pension clients start to move away from 24-month segment rates into the PPA yield curve. That, in my mind, will mark an important tipping point in the overall de-risking and LDI conversation. So when you see that start to happen, and that's probably won't happen until rates start to go up and sponsors get the benefit of a higher spot rate in their funding, I think that'll be a very helpful point in time. And then the third thing is mark-to-market accounting. It's been out there for a long time. There's been some high-level changes to the accounting environment, but generally speaking, the accounting issue or mark-to-market accounting, pension accounting, has still sort of been kicked down the road a little bit. So if and when that happens, I think it'll be net positive for LDI and pension risk transfer. So here we have a slide that talks specifically about retiree benefit payments and some significant challenges that they create for pension plans. Again, we're grounding this conversation in fixed income, and we're trying to ground this conversation around the benefits of cash flow matching. So when we think about cash flow matching, the cash flow that goes out the door for a pension plan to pay benefits is a pretty big component, probably their largest expense. But if I had to title this slide more succinctly, it would be just simply cash flow matters. And I think we've seen this over the years as we've worked with pension plan stakeholders to help them evaluate kind of how and when to annuitize. One of the things that we've found is that pension plans have a very unique challenge in that there's two fundamentally different types of liabilities which they're trying to fund. The first is retirees, which we're focused in on this slide, where investment income is needed to pay current benefits. But the second group is the non-retired group, where there are no liabilities due immediately, and the investment portfolio can focus on growth to minimize the expected cost of funding the plan. So two different sets of liabilities, one investment portfolio trying to get both growth and income. In essence, a balanced fund is what most plan sponsors are managing. When you look at how they're allocating their assets more towards growth or more towards income, it seems as though most plan sponsors have focused on growth, trying to minimize expected cost, and that they're giving up having income to actually pay benefits. So this gets at the issue of cash flow mismatch that we see. It's not uncommon to see 5 to 10% of the plan assets going out the door every year to pay benefit payments. When we look at those same plans and say, well, how much income is being generated by the investment portfolio, it's typically half. So I think that creates some pretty interesting issues for pension plan sponsors. Again, it's probably down a couple levels than where most of their conversations are. I think most of the conversations that pension plan sponsors are having around how do I earn 8% and how do I extend duration? So we're down a couple levels, but we think it's important for plan sponsors to understand this cash flow mismatch issue. And at the end of the day, we think that there's some ways to insure against these risks. Again, we go back to insurance products being cash flow matched vehicles, and cash flow matching is really the bedrock of how insurance companies invest. When you think about the fact that a pension plan is really a tiny little insurance company embedded within the balance sheet of the sponsoring company, right? And it's probably very uncorrelated to their core business. We think that cash flow matching, probably deserves a seat at the table. And again, we're not necessarily advocating that plan sponsors go in and cash flow match their whole plan today when they're 70% funded and arguably can't afford to do so. But we do think there are some strategies with the products that are in the marketplace today that allow for a very interesting conversation around how cash flow matching can be very helpful. All right, so what are those strategies? Well, again, if we're talking about the retiree population, we think there's two different strategies that clients may find utility in around annuitizing. Buyout annuities and buy-in annuities. We talked about these a few slides ago, and we'll dig a little deeper here. But the first thing that is worth mentioning is that it's really the objectives of the sponsor that are going to drive whether either of these is an attractive solution. So that's the way we've tried to design this slide and isolate the circumstances that would potentially make one or the other of these more attractive to a client. So you see those in the colored boxes at the top. And I think one of the fundamental questions that we ask clients when we're trying to evaluate, the appropriateness of a buyout annuity is, can you afford to terminate? And when sponsors think about that question, they think about the cash they have within their business, but also increasingly the access that they have to inexpensive borrowing. So many clients are looking at those two, and they're saying, for some it's clear, no, they can't afford to terminate. But for many, it's, I could afford to terminate. It's just a question of, do I think that I'm getting good value for the money if I were to use that money to get rid of the pension plan? So another interesting question for that group as they think about buyout annuities is paying down a portion of the obligation a useful step in terms of exit strategy planning? Again, by asking that question, we're trying to get sponsors to think about moving away from an all-or-nothing kind of plan termination. The only time you buy out liabilities is as part of a plan termination process. And we understand that is certainly the easiest, simplest way to think about closing out your pension plan, but maybe not always the most optimal. Sort of an all-or-nothing approach where the sponsor is sort of setting themselves up to be either all right or all wrong. But the reality is, in this environment, for a lot of plan sponsors, they're either not going to be able to afford to buy out, or they're not going to see value in locking in their current position. So for those groups of pension sponsors, there's a different question that we ask. And that question is, are you focused on de-risking or immunizing with fixed income investments? And for a lot of clients, if the answer isn't already yes, it will be yes a year from now or 2 years from now as the LDI conversation begins to become more core to how pension plans are discussed and managed. So underneath that question, I think the other question that we ask is, well, what are the limitations of traditional benchmark-driven pooled fixed income funds, so mutual funds and collective investment trusts, and their ability to provide a custom liability hedge? So we think, again, that insured products can do some things in terms of customization that pooled benchmark-driven fixed income funds just can't do. And at a certain point, that'll be interesting for pension plan sponsors to sort of think about in terms of who they put their fixed income dollars with, whether it's a fixed income manager or whether it's an insurance company in some sort of institutional insurance contract. I would say, as we close out this slide, that for plan sponsors that decide not to engage these solutions, our goal as a specialist that focuses on this stuff is to try to make sure that pension clients who forgo these options do so from a position of understanding and knowing exactly what the solutions are and what they do, what they don't do, and how they compare both pros and cons to the other approaches that they're going to use to manage their pension program. Especially important for frozen sponsors who are looking to strategically plan to exit the pension business. So Krista is indicating me that there's a question coming through.
Yes, this is a good one. Why would a pension sponsor want to lock into an annuity purchase in the current environment with rates so low?
We've been getting that question for 10 years, but you know, and every year rates get lower, so it's a fair question, and it's not just a question that annuity practitioners have to answer. It's sort of even all the LDI guys have the same issue. But a bunch of things come to mind. The first thing is Japan, and Japan has been in a low rate environment for more than a decade. So that's the first thing that comes to mind. You think about over here in the U.S., well, what's the outlook for rates? And I think the Fed was pretty clear that they have no intention of rising rates any sooner than middle of 2014. So we're clearly going to be in a low interest rate scenario for a couple more years. Other things that sort of strike me would be the limited supply of long duration bonds. So as more plan sponsors rely increasingly on fixed income, the buying of those bonds is going to further kind of keep bond yields down. So again, don't know exactly how this will all play out, but when you look at the environment, you can say there's a bunch of reasons why there may be more value in the marketplace today than you think. Another issue that comes up is the issue of insurance carrier capacity, and what is the market going to look like if and when everyone wants to do this? Clearly, insurers will have pricing power if and when that day comes, and that will erode some of the value that clients think they're getting. So right now, insurance carriers are pricing up, these liabilities pretty bare bones. It's pretty competitive out there. So from that perspective, pension sponsors that have the courage to engage these solutions are getting a good deal in many respects. The last thing worth mentioning is that credit spreads are still fairly wide. Annuities are discounting out at more than 300 basis points over cash. So that's pretty attractive on a historical basis. Again, thinking about the retiree liabilities, the negative cash flow, and putting all this in a pot and stirring it around, from where we sit, annuities look like a tremendous value. The last thing I would add is that sponsors, again, should not feel that they need to do this all at one point in time. Again, moving away from this sort of terminal funding mindset, I think is going to be important for pension plan sponsors to consider, or else they're going to be in a position to be kind of all right or all wrong around how and when to exit their liabilities. All right, so the reality is, for some plan sponsors, right, annuitization today isn't going to make sense. They're going to be unable or unwilling to lock in their annuity costs, and we still have additional solutions that we can talk about with those clients. This slide is designed to talk about one of those new structures. We touched on it a little bit earlier. It's called Insured LDI. It's a new product that came to market in early 2011. Just announced the first sale end of last year. And in this structure, the insurance company is guaranteeing the actuarial valuation cash flows will be valued equal to the pension discount curve. And again, we're talking spot rate here, used to define the liability. So whether that's the PPA yield curve, the Citi curve, And for you cherry pickers out there, they'll even guarantee firm proprietary curves. One of the really interesting things about this structure is that it is fee-based. It's pay-as-you-go, and there are no embedded loads or costs to provide the guarantees the way that kind of annuity buyout buy-in products typically work. So from that perspective, a fundamentally different structure and fundamentally different economics in terms of the feasibility of implementing this solution in the current environment. Generally speaking, this approach should be cost neutral for pension plans as opposed to an annuity structure where you have to prepay in those present value embedded loads which can create the perception of additional costs. So the fact that the contract is valued using the same mechanism that the plan values its own liabilities, we think is a very interesting proposition for plan sponsors. This product really solves the challenge of pension indices being uninvestable. I think asset managers sometimes refer to the issue as the downgrade headwind issue associated with pension indexes. So when issues within the index get downgraded, they fall out, and that creates the index having sort of an artificially high either credit profile or I guess it would be lower yield, and that's something that creates a challenge for on the asset side, because when the issue in your asset portfolio gets downgraded, well you feel that because you hold on to it. So this contract is designed to be really a custom LDI alternative to a long bond fund, and it really provides an exact liability hedge in one black and white guarantee contract. So we think this product is very, very interesting for plan sponsors that are looking at kind of long bonds as their sort of core fixed income allocation moving forward. And we have a question on this slide, I guess.
Yes. The question is, are any of the strategies that you've discussed today more attractive than others?
Yeah, it's a good question, and sort of a natural question, I think. I would say the answer is always going to depend on the sponsor and their objectives. That's sort of my diplomatic answer. But if I'm being a pragmatist and sort of looking at the market, where rates are, and kind of how underfunded many plans are, I'd say that given that state of the market, that immunization or non-settlement structures, so for what we talked about today, that would be insured LDI, that would be buy-ins, and that would be even fixed crediting rate products, are going to likely be more feasible today. But that said, there's clearly a growing group of sponsors who are working diligently to determine how and when they're going to buy out their liabilities, and they recognize that that's their ultimate goal line of where they're trying to go. So bringing it back again to the football reference, for anyone who does a non-settlement solution, there's still going to be the need to settle the liabilities if and when they get to that plan termination event. And 5 questions to consider. So we wanted to give people on the call a couple things to think about, and willing to bet that for most people on the call are going to be able to say yes to many, if not all, of these. And wanted to use this slide to again highlight the fact that Dietrich Associates is a specialist firm. We focus on working with institutional annuity products, and we really see our work as highly complementary to other pension stakeholders. We are not investment advisors. We don't do asset allocation work. We are not actuaries. We don't value liabilities. So, we're very ready, willing, and able to interject our expertise along with yours to be able to help clients sort of think about these solutions and figure out if and when they can add value to how they're trying to manage their pension program. I'd say that while pension risk transfer in our work around it is in many ways, I think, becoming more important to frozen pension plan sponsors, it's challenged by the fact that pension risk transfer doesn't fit neatly into the core services of investment consultants and actuaries. So I really see there being a need for specialist firms to partner up with more general practitioners to be able to make these solutions come to life with clients. So we're here to help, and to try to demonstrate that. We've been actively trying to develop tools to help create engagement in the marketplace. Our pension risk transfer index is one example. It provides a high-level monthly barometer of the relative attractiveness of annuitizing. We rolled this out about 6 months ago, and it's been very well received by plan sponsors, investment consultants, and actuaries. So if you haven't seen that, I encourage you to go over to dietrichassociates.com, find it, download it. If you'd like, feel free to reach out to us. We're happy to jump on a call to explain how it was derived and kind of talk a little bit about some of the mechanics. Our index doesn't replace engaging a specialist firm like us directly, but we do think it helps illustrate the benefits of being prepared to act. And we think it's a useful first step for folks who are on this call and they're reflecting about what they've seen and heard and trying to think about what can they do as a next step to take action regarding risk transfer. The index could be a very helpful tool to create further engagement in these sorts of solutions. So we have about 15 minutes left here. I guess I'll kick it back to Krista to see what other questions might be floating out there.
Sure. The first one is, do you have any perspective on the capacity constraints of the insurance industry to meet the demand if and when plans begin to annuitize at a rapid rate?
Yeah, this has come up a lot in the last year or so. A couple things. One, I think if I think about the pace of sales that we've seen in this marketplace in the last couple of years and the maturity of the business that's already on the insurance carrier's books, clearly insurance companies are releasing reserves more quickly than they're adding reserves for new sales. So said differently, the annuities that are already on their books are dying off more quickly than they're selling new annuity guarantees. So I think every year this environment persists. There's actually growing capacity in the marketplace. But, people say there's some really big plans out there looking at this stuff, and that if and when they come, that capacity can become an issue fairly quick. So I can't sidestep the question altogether. I would add in that as those buyers come to the market, I think you'll see new carriers step in. There's carriers that have been in this marketplace for years that have stepped back because the state of their business has required them to. So I think you'll see new people come back in. You'll probably see one or two carriers that haven't been in this marketplace over the last 10 years. And then the other thing is I think, carriers will raise prices and will find ways to adapt their businesses to meet the demand. So I don't see capacity as being as big of an issue as maybe some other people in the marketplace, but I guess we'll just have to see how it all plays out. Anything else?
Yep, I've got another one here. What steps can a pension plan sponsor take to begin to more effectively consider insured pension risk transfer?
Yeah, I think there's sort of two things. One, I think that they can raise the issue with their existing consultants. So I think by being proactive in inquiring, I think that goes a long way towards cueing the consultants around where are the hot buttons for a client, and that as sponsors increasingly do that, I think consultants will smartly try to respond to their clients' needs and desires. So I think there's a burden on the sponsor to educate themselves and kind of ask the right questions. The second part of answering that question is probably a little bit of a shameful plug, but I would say engaging a pension risk transfer specialist is probably a useful step as well, because I think if I think about how this market plays out, again, pension risk transfer is neither fish nor fowl. It's not clearly part of actuarial services, nor is it clearly part of investment consulting services. So from that, I deduce that perhaps it's a standalone service or advisory function, however you want to think about it. So for plan sponsors that have the appetite, I think engaging a specialist firm probably makes a lot of sense and may help improve their governance and decision-making processes.
Great. I've got another one for you, Jay, if you're up for it.
Sure.
Sure. It says, do you see plan sponsors' decision-making processes as a challenge for many of your clients?
Simply put, yes. I think what we tend to find is that the pension plan is fairly complex, and some of these asset liability issues, while we can talk about them for an hour on a Thursday afternoon and put together a PowerPoint deck, and it all sounds fairly simple. The reality is the people that are making decisions here are more focused on their core business, and they oversee the pension plan very much as off the side of their desk. So, the issues around LDI and funded status volatility and all that sort of stuff, they require fairly nimble, tactical, purposeful decision making. And I think sometimes pension committees aren't exactly set up for that. So there's a bunch of education. There's definitely a sequence of conversations that need to happen in order for this stuff to actually come to life in a way that decisions can be made effectively. So I think it's a huge issue, and I think it's a great question that affects every pension sponsor and their service providers out there today.
Great. I've got a few more. I think we have time probably for one more. So this one is, please comment on the number of insurance companies that offer annuities now as compared to the number 3 years ago.
That's a good question. I think right now we see about 7 or 8 carriers in the marketplace, and that's probably down 2 or 3 from where it was a couple years ago. The guys that got out because their business was impacted by the credit event or the economic issues that came in 2 or 3 years ago, the way many companies were. So for a lot of companies, for 2 or 3 companies, they sort of said, well, we don't see this as a real core business line, moving forward. We're gonna take a step back. Now they're clearly retaining all the business to service all the business that they have, and they've said they'll be opportunistic as the market changes on a go-forward basis. So we expect those firms will come back, when the market rebounds. If and when we get back to that $3-4 billion a year of annuity placements, we would expect those guys to come back. The 7 or 8 that we still have, we see sort of a couple different groups of carriers in there. Very rarely will you see all those carriers in on any one given placement. So certain carriers are more interested in smaller size deals, and the size of the carrier doesn't necessarily allow them to deploy the capital to write this business for plans of all different shapes and sizes. So we see some carriers more focused on smaller cases. We see other carriers that are very opportunistic and like to see certain types of deals, so perhaps more retiree-centric and slightly larger deals as sort of their sweet spot. So those carriers tend to kind of be in and out of the market based upon the profile of the case. And then there's a couple carriers that are kind of in the market fairly consistently in really looking to compete aggressively on the larger deals that come into the marketplace. So every year you're going to have a handful of larger deals that drive the market, certainly from an insurance carrier perspective. And typically you get your most diverse bidding group on those cases.
I think we've got time for one more quick question. If a plan sponsor wants to start an annuity buyout for its retirees, what is the smallest number or dollar volume to make economic sense?
And I don't know if there's an easy answer to that. I think it depends on the size of the plan. I think a really small plan, it's probably not going to make sense to do a bunch of different buyouts for a tiny plan. But for a plan that has a fairly significant chunk of retirees, and when I say fairly significant, I would say a couple hundred or more. I'm not sure there is any exact correct way to do it. I think it could be done in 2 placements. I think it could be done in multiple placements. Even having a standby contract ready and annuitizing people as they come up for retirement could be an attractive option for sponsors to think about. Should they be annuitizing the oldest people? Should they be annuitizing the youngest retirees? Male, female, large benefit, small benefit. There's a lot of different ways to potentially slice and dice your retiree group to try to find value in figuring out which benefits to annuitize and when. And that's probably a process that we as specialists work very closely with actuaries to try to figure out what is the right group and how should we sort of calibrate the purchase in a way that makes sense, given a bunch of other things that a pension plan sponsor is going to need to do. If they're not terminating their plan, they're going to need to continue to invest and fund their plan. So any annuity purchase done outside of a plan termination is going to need to be cognizant of the fact that there's going to be assets and liabilities left behind. So strategic buyouts or buyouts done outside of plan termination do require a fair bit of coordination with the investment consulting firm and with the actuarial firm as well in order to pull it off in a way that really makes sense for the whole pension plan.
Great. Well, I think that's all the questions we have time for this afternoon. All questions otherwise can be answered individually. I've got copies of all the questions. And also, we have a recording of this webinar that we'll be emailing out to all the attendees. Anybody that was not able to attend, if you'd like them to receive that as well, please contact us and let us know. Jade, mind forwarding on to the last slide, please. Great. For more information on pension risk transfer and Dietrich Associates,